What's going on, guys? It's Jordan de Jong here, and today I want to talk to you about negative interest rates. And although it sounds almost taboo and unfathomable here for us in Australia, it's pretty straightforward to comprehend. Currently, even though we're in a very low interest rate environment, it's still a positive interest rate one. So when we store our currency in a bank, they pay us interest on our savings amount. Alternatively, if we pull out debt with a bank, we have to pay them interest to be able to borrow that money. When we think about a negative interest rate environment, we just flip this the other way around. So if we had savings stored in a bank, it would cost us money to hold it there. And if we pulled out debt, we'd be getting paid to do so. Sounds too good to be true, right? Imagine getting paid money to pull out a mortgage. Well, that's just a theory. There's a long way to go before we'd see anything like that here in Australia. But it still shouldn't be ruled out, as we have seen it in other countries, which I'll get into later in this video. So why would we set negative interest rates in the first place? Well, in some theorists' perspective, it would stimulate spending. Instead of holding currency in a bank account that's costing us money to do so, wouldn't we be better to just spend it now instead of losing money by sitting it in an account? Additionally, the population is encouraged to pull out debt by getting paid to do so, which means they've got more access to credit than they would have previously, and therefore may have more temptation to spend some. In reality, it's just a different way of thinking. Just like some people with large amounts of money are benefiting from a positive interest rate environment right now, in reverse, people with large amounts of debt would be benefiting from a negative interest rate environment. Theoretically, and this is not advice to get in large amounts of debt. So it helps some and it hinders others. If we did flip the switch, imagine all of the retirees who were living off the interest repayments for the large sums of money. Well, over the last 12 months, their income has been cut dramatically. And if we went negative, their savings would start to be cut into. Now, what about the savers? Like myself, me personally, I'd probably want to keep it in cash hidden somewhere, which means it's not in the banking system, it's unsecure, and it's in a form of currency that's rapidly becoming outdated. And we're consistently seeing digital currency being used more frequently in society. Speaking of this physical form of currency, in a bill set to pass federal parliament, cash payments over $10,000 are set to be banned in Australia. Under the proposed legislation, those using cash above that limit would be made to carry out a 2-year jail sentence. Seems fishy, right? Given we may be heading into negative territory and no longer want to hold our cash in the bank. Well, that's at least what some conspiracy theorists think this bill is all about. The minister in charge of the bill, Michael Sucker, said that the laws were a recommendation from the government's Black Economy Task Force as a means to prevent criminal gangs using large cash purchases of cars, houses, and jewelry to launder their gains from illegal activities. The key focus of the bill is reducing the ease to which organised crime gangs can operate through the country, Mr. Sucker said. Before we get any further into the depths, I want to make it clear that I'm no economist. I'm just a humble civilian making an observation. Nothing talked about in this video should be considered as personal advice. However, if you are loving this content, don't forget to smash that like button. So, the big question, will we see negative interest rates here in Australia? I'm good friends with a couple of people who think that we will. Everyone's got their own opinion, agendas, and biases. However, all we can really do is sit by and try and decipher the Reserve Bank of Australia's meeting minutes and speeches. In the opening statement to the House of Representatives Standing Committee on Economics on the 7th of February 2020, Governor Philip Lowe from the RBA stated that negative interest rates in Australia are extraordinarily unlikely, and this is not the direction that we want to go in. So although it's extremely unlikely, it hasn't been completely ruled out. And to put it in perspective, a couple of years ago we would have never guessed that interest rates would have been at 0.25 basis points. The RBA does, however, recognise the consequences. In another speech responding to the economic and financial impact of COVID-19 from Governor Philip Lowe on the 19th of March 2020, he also stated that low interest rates do have negative consequences for some people, especially those relying on interest income. In the same meeting, he also mentioned, at its meeting yesterday, the board also agreed that it would not increase the cash rate from its current level until progress was made towards full employment, and that we are confident that the inflation will be sustainably within that 2 to 3% range. This means that we are likely to be at this level of interest rates for an extended period. Seems to me like they are way more stubborn about not going up than actually coming down. So how could a negative interest rate society work where we can't pull out large sums of cash but would probably want to do it anyway? Well, an IMF blog post has proposed something worth considering. The proposal is for the central bank to divide the monetary base into 2 separate local currencies, cash and electronic money called e-money. e-money would be issued only electronically and would pay the policy rate of interest, and the cash would have an exchange rate, also known as a conversion rate, against this e-money. This conversion rate is key to the proposal. When setting a negative interest rate on e-money, the central bank would let the conversion rate of cash in terms of e-money depreciate at the same rate as the negative interest rate on the e-money. So the value of the cash would thereby fall in terms of that e-money. To illustrate, suppose your bank announced a negative 3% interest rate on your bank deposit of $100 today. Suppose also that the central bank announced that the cash dollars would now become a separate currency that would depreciate against e-dollars by 3% per year. The conversion rate of cash dollars into e-money would hence change from $1 to $0.97 over the year. And after a year, there would therefore be 97 e-dollars left in your bank account. If you instead took out $100 of cash today and kept it in a safe place at home for a year, exchanging it into e-money after that year would also yield $97. I'll leave a link to that blog post in the description section below so you can do some further reading. Pretty interesting, but would it actually work? Well, we are currently seeing negative interest rates in other countries. Denmark was the first country to deploy a negative policy rate in 2012, and today has banks actually paying people 0.5% to borrow for housing. The Eurozone has had negative rates since 2014, Sweden and Switzerland since 2015, and Japan since 2016. The theory behind negative rates in those economies is straightforward. Banks are required to hold a lot of cash with their central banks to protect against a run on their deposits in a moment of financial crisis. If the central bank charges the banks rather than pays them a positive rate on those deposits, they would be more inclined to lend those funds to stimulate the economy activity. The two biggest experiments with negative policy rates have been in the Eurozone and in Japan. In Europe, the European Central Bank is charging banks 0.5% for deposits, and in Japan, the Bank of Japan is a 0.1%. The performance of both those economies since they've introduced negative rates would suggest that the policy has been less than effective. The Eurozone's annual GDP growth has been about 1.8% since 2015, and Japan's is less than 1% since 2016. This is from another article by SMH released on the 2nd of June 2020, which I'll also leave in the description section below, but essentially it indicates that a negative policy environment isn't really as effective as we think it would be. So, do we hold off fixing our mortgage rates to see if we can go negative? What if we don't go negative and we miss out on an opportunity to lock in at a low rate? These are all questions going through many people's minds, and I guess no one really holds the answers. We are seeing fixed loans being issued with interest rates starting with a 2. Variable rates starting to creep into the 2s, but mostly start with a 3. So we would need to see the cash rate drop another 75 basis points or so to negative 0.5% to see that the variable interest rates lower than the currently locked in fixed rates. And even then, would the banks pass on this rate cut in full? This is unknown territory for Australia and something we have never seen before. I want to know what you guys think will happen to negative interest rates here in Australia. Leave it down in the comment section below. As always, seek your own professional financial, legal, taxation and property investing advice for your current situation. These videos are just my opinion and are general in nature and should never be considered as personal advice. If you're keen for more content, make sure you subscribe and smash that notification bell so you don't miss a video. And until next time, happy house hunting.